Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Good to be here.
Yeah, and just to set the stage, it is Friday, February 27, 2026.
Mm-hmm.
And I have to say, looking at the screens today, we've got a lot of red.
A sea of red in some sectors, yeah.
Right, a lot of red, but then a little bit of green where you probably least expect it.
Exactly.
The narrative just feels like it's shifting right under our feet today. So for this deep dive, we are putting aside the sort of broad philosophical tech discussions, and we are putting on our pure financial analyst hats.
Because we really need to.
We do. Because the signals we are getting from CNBC, Bloomberg, and Yahoo Finance this morning are, well, they're conflicting, to say the least.
That conflicting is honestly putting it politely. I've been staring at the terminal since the pre-market opened, and it feels like we are right in the middle of a massive rotation.
Like a tectonic shift.
Yeah, exactly. It's one of those weeks where the headlines say one thing, like strong earnings, right? But then the actual price action tells a completely different story. We are seeing good news treated as bad news. And in one specific case we're definitely going to get into, terrible news for employees is being treated as just incredible news for shareholders.
Yeah, that efficiency trade we're seeing is just brutal right now. But before we get to the whole tech bloodbath, we need to address the resolution of a really massive storyline we've been tracking for, what, months?
Literally months.
The bidding war for Warner Bros. Discovery, ticker WBD. It actually appears to be over. The headline from the CNBC Daily Open today is that Netflix has officially left the building.
They walked away. And frankly, I mean, this is the most Netflix move possible, if you think about it.
How so?
Well, you have to remember the context here. For weeks, the Strait was just speculating that Netflix might overbid.
Right, just to secure the library.
Exactly, just to keep the Warner Bros. Library out of a competitor's hands. I mean, we're talking Harry Potter, DC, all the HBO content.
That's a massive catalog.
Huge. But the reports this morning confirmed that Netflix just decided not to increase their counteroffer. They looked at the price tag and just said, no thanks.
It really is a fascinating display of discipline. I was looking at the aftermarket reaction, and investors clearly loved it.
Oh, they ate it up.
Yeah, Netflix stock, NFLX, it popped over 6% during the session and then added another percent or so after hours.
Around 7.6% total, yeah.
Right. The market is actively rewarding them for not spending money, which to me, it tells me that shareholders believe Netflix's organic growth engine is strong enough that they just don't need to buy a legacy media giant to survive.
That is exactly it. It comes down to the churn argument.
Walk us through that.
Sure. So Netflix has the lowest churn in the industry. Once people subscribe, they stay. WBD has much higher churn. So from Netflix's perspective, why buy a leaky bucket when your own bucket is watertight?
That makes perfect sense.
Right. By walking away, they avoid all the integration risks, all the debt. But this decision has a massive ripple effect because with Netflix out, the path is completely clear for the rival bid.
Paramount Skydance, ticker PSKY.
Yes.
And we are not talking about some small bolt-on merger here. This is a $111 billion deal. It creates an absolute behemoth.
A total monster in the media landscape.
But there's a specific detail in the Yahoo Finance report regarding the breakup fee that really caught my eye.
The $2.8 billion.
Yeah. Usually, the target pays the fee if a deal falls through. But here, the structure is completely unique.
It is, and it really shows you just how desperate Paramount Skydance was to close this thing. Paramount actually agreed to pay a $2.8 billion breakup fee that Warner Bros. Would have owed Netflix if the deal fell apart.
That is wild.
Essentially, Paramount Skydance is saying, hey, we will pay off your liability to the guy who just walked away just to get you to sign the papers with us.
That is a massive sweetener.
Yeah.
They are basically buying WBD's freedom to merge.
Exactly.
And looking at the tickers today, Paramount Skydance popped about 7% on the news. So the market clearly thinks they got a prize here.
They do.
Meanwhile, Warner Bros. Discovery actually fell about 2%. I'd suspect that's simply the arbitrage premium evaporating, right? Now that the bidding war is officially over,
Wow.
this stock just settles back down to the actual deal price.
That's exactly what's happening. The drama is over, and now the really hard work of integration begins for them. And speaking of the drama, it's worth noting that Netflix CEO Ted Sarandos was reportedly in Washington, D.C., actually at the White House, right as this news broke.
Really?
Yeah, it just adds this crazy layer of geopolitical intrigue to what is already the biggest media consolidation story of 2026.
Wow. Okay, so media's consolidating. But if we pivot and look at the broader technology sector, we aren't seeing consolidation at all. We are seeing what looks like a civil war. I'm looking at the NASDAQ composite. It closed down 1.18%. But that headline number really hides a violent rotation underneath. We are seeing this historic divergence between software and hardware.
Violent is the right word for it. If you look at the data we pulled from CNBC Market Insider, the software and services industry group has fallen 16% in just the past month.
16% in a month. That is deep correction territory.
It's awful. Investors are just fleeing software companies that rely on future growth promises, and they are piling into hardware companies that are printing cash right now.
And nothing illustrates this dynamic better than the story with Block, formerly Square.
Oh, boy.
I was looking at the after-hours tape yesterday, and I genuinely thought there was a glitch on my screen. Block shares soared 24%.
It's crazy.
In a normal market, you'd assume they announced a massive new product or maybe tripled their revenue guidance.
But in this market, it was the exact opposite. They announced a complete dismantling. Block stated they are cutting their workforce by nearly half. They are firing over 4,000 employees.
Let's just pause and think about that for a second. 4,000 people. That is half the building. And the stock goes up 24%.
Yeah.
It is the most cynical signal Wall Street can possibly send. It's essentially saying, we value your profit margins significantly more than your capacity to innovate.
It's the ultimate efficiency trade. Investors looked at that massive headcount reduction, and they just did the basic math on the cost savings.
Right.
They realized that by cutting half the staff, Block's bottom line is going to look absolutely incredible next quarter, even if their actual top-line growth stalls out. It is short-termism at its peak, but it is exactly what the market is rewarding right now.
And God help you if you are a software company that isn't firing everyone, and you also happen to miss your numbers. We saw an absolute bloodbath in the rest of the SaaS sector.
We really did.
Zscaler is the one that really stood out to me from the coverage. They were down nearly 10%. I dug into the CNBC report on them. And the issue wasn't necessarily their current revenue, it was their deferred revenue.
Right. And for listeners who might not track SaaS metrics every single day, deferred revenue is basically the lifeblood of these software-as-a-service companies.
How so?
It represents money collected for services that haven't actually been delivered yet, so subscriptions for next year, basically. It acts as a proxy for the future sales pipeline. Zscaler reported $2.36 billion in deferred revenue, which missed the whisper numbers on the street.
So if deferred revenue is light today, it means the sales team isn't closing new deals fast enough. It's a leading indicator that overall growth is going to start slowing down 6 to 12 months from now.
Precisely. In a massive bull market, investors might just overlook a slight miss in deferred revenue. They'd give them a pass.
Right.
But right now, the market is actively looking for any excuse to sell software. Look at Intuit, the TurboTax guys.
Yeah, down 7%.
Exactly, dropped 7% just because they missed guidance. They forecasted EPS of roughly $12.50, and the street wanted almost $13. That is a very small miss in the grand scheme of things, but the punishment was severe.
Even Salesforce, ticker CRM, was down almost 2% just on sympathy.
Yeah, dragged down with the rest of them.
So capital is clearly fleeing software, but it has to go somewhere.
Yeah.
And looking at the leaderboards, it is pouring straight into hardware. Dell Technologies is having a massive moment.
A huge moment. Dell jumped 10%. And this is directly connected to the AI build-out we keep talking about.
Right.
While software companies are really struggling to monetize their new AI features, Dell is selling the actual physical servers that run the models. They beat earnings with $3.89 per share versus expectations of $3.53. Revenue was over $33 billion.
It's the classic picks and shovels play. Dell is out there selling the shovels. But of course, we have to talk about the company making the metal part of that shovel, NVIDIA.
Always NVIDIA.
They reported earnings, they absolutely crushed the numbers again, and yet the stock fell 5% intraday before finally stabilizing. CNBC ran a whole segment on this idea of peak pricing power. Is this the top for NVIDIA?
That is the multi-trillion-dollar question right now. NVIDIA's gross margins are currently sitting at 75.2%.
Which is insane.
For a hardware company, that is astronomical. Usually, hardware margins are razor thin. So the bear case forming right now is that as supply chains improve, and we are seeing what they call improved visibility in supply, The scarcity factor goes away.
And when scarcity goes away, pricing power drops.
Exactly. Pricing power drops, and those 75% margins inevitably revert to the mean.
But Jensen Huang, NVIDIA's CEO, he came out swinging against that entire narrative. I caught his comments in the Bloomberg wrap-up. He argued that it's not just about scarcity at all. It's about what he calls performance per dollar.
That's his key metric.
Right. Essentially, he's claiming that even if the chips are extremely expensive upfront, the computational output you get per dollar spent is so high that the margins are completely justified.
It's a very strong argument. He's basically saying, we aren't just selling you expensive chips, we're selling you deflationary productivity.
Deflationary productivity. That's a great way to frame it.
Yeah. And it's also worth noting that Jim Cramer on Mad Money actually defended the stock during this dip.
What was his take?
He views this sell-off not as a referendum on a broken company, but just as institutional rotation. Big funds have made so much money on NVIDIA over the last 2 years that they're simply taking some chips off the table to rebalance their portfolios. It's prudent portfolio management. It's not a panic sale.
So capital is rotating out of U.S. software, and it's shifting into U.S. hardware. But it's not stopping at the border. One of the most interesting threads in the CNBC Daily Open today was the flow of capital into emerging markets, specifically India.
This is such a crucial part of the global puzzle right now. While the U.S. tech sector is fighting this internal civil war, India is posting just incredible growth numbers. The CNBC report shows India's economy grew 7.8% in the December quarter. That blew past all expectations.
And what's really fascinating is how this ties right back into our hardware discussion. This isn't just agrarian growth or basic textile manufacturing driving these numbers. It is high-tech capital expenditure. There's a firm mentioned in the report, Yotta, an Indian data center company.
Yes, Yotta. They are currently building a $2 billion AI hub right there in India. And what are they filling that massive hub with?
NVIDIA GPUs.
NVIDIA GPUs. So you see the cycle here. U.S. investors might be wringing their hands, worried about NVIDIA's peak pricing power. But Indian infrastructure companies are buying every single chip they can get their hands on. The demand is totally globalizing.
So what does this all mean? It means the AI boom is going global, even if U.S. markets are a bit jittery. That really validates the bull case for the hardware guys. But while India is surging at 7.8%, the mood surrounding the U.S. macroeconomy feels incredibly fragile today. We have the PPI data, the Producer Price Index, dropping at 8:30 a.m.
And that data point is going to set the tone for the entire next week. Economists are looking for a 0.3% rise.
Right.
If it comes in hotter than that, it signals to the Fed that inflation is still sticky. But the real danger signal I am watching today isn't just the inflation print, it's the bond market. The 10-year Treasury yield is hovering right at that psychological 4% line, roughly 3.99% to 4.01%.
We talk about yields a lot on these deep dives, but let's drill down on exactly why this 4% level is so dangerous for the stock market. It's really about the spread, isn't it?
Exactly. It is all about the risk premium. Think about it from a portfolio manager's perspective. If I can get a guaranteed 4% return from the U.S. government, completely risk-free, why would I take the risk of owning a highly volatile software stock like Zscaler?
You wouldn't.
Right. As yields go up, the hurdle rate for owning stocks goes up. Stocks have to become significantly cheaper to be attractive compared to bonds. That is exactly why when yields spike, PE ratios usually collapse.
And there was a genuinely disturbing report in Bloomberg today suggesting that the baseline demand for that U.S. debt might be drying up. This is the whole bond vigilante scenario.
It is the absolute nightmare scenario for the Treasury. The Bloomberg report highlights fears that foreign allies, specifically traditional reliable buyers like Japan and the UK, might actually flee U.S. debt.
Why now, though?
This is tied directly to the current political climate. The report notes there is genuine anxiety abroad about the Trump agenda and the specific threat of broad tariffs.
Right. The logic being, if the U.S. slaps massive tariffs on Japanese goods, Japan inherently has fewer dollars to recycle back into U.S. treasuries.
Exactly.
Or worse, they intentionally stop buying them out of retaliation, or they have to sell them to defend the yen.
Precisely. And on top of that, we also have the legal headlines today. The Trump DOJ is facing its first big court deadline regarding tariff refunds.
Right, I saw that.
It just creates so much uncertainty in the fixed income markets. If foreign buyers step back, the question becomes who buys the debt? The U.S. government then has to offer much higher interest rates to attract domestic buyers. That sends Treasury yields up, it sends mortgage rates up, and it sends corporate borrowing costs up. It acts as a massive, heavy brake on the entire economy.
So we have this incredible tug-of-war happening. On one side, you have the AI productivity boom, represented by Dell and NVIDIA printing cash. On the other side, you have the macro weight of U.S. debt and sticky inflation dragging everything down.
It's a very tense market.
And just to sprinkle a little more anxiety on top of all of that, we had a geopolitical update regarding Iran.
A brief but very significant update from CNBC, yes. The U.S. and Iran just wrapped up what officials actually called the most intense nuclear talks to date.
And the result?
No deal.
Which means the geopolitical risk premium built into oil prices isn't going away anytime soon. It's just another inflationary pressure.
Absolutely.
But I want to end this deep dive on a slightly different note regarding global capital. We talked about India, we talked about the U.S., but CNBC Daily Open had a truly fascinating nugget about Norway.
Ah, yes. The Sovereign Wealth Fund.
The $2 trillion whale. They are usually very, very conservative in how they operate, but they are integrating AI into their workflow in a way I frankly didn't expect.
It is a phenomenal example of practical enterprise AI use. They aren't just out there buying AI stocks to hold. They are actually using Anthropic's Claude model to scan their own portfolio.
How exactly are they using it?
They are using it for ESG risk monitoring. Basically, they have the AI read through millions of pages of legal filings, environmental reports, and news articles to instantly spot governance or climate risks in the companies they own.
Wow. Which really brings this whole conversation full circle today. You have the world's largest pile of capital, Norway, actively using AI software to manage their risk. You have India aggressively building the hardware infrastructure with NVIDIA chips. And you have the U.S. market ruthlessly cutting human costs to improve efficiency and buy into those very same tools.
That really is the perfect summary of the week. It is a market that is demanding tangible, immediate results. The entire era of growth at all costs in tech is completely dead. We are now firmly in the era of efficiency and cash flow.
Show me the money.
Exactly. If you can show the cash right now, like Dell or Netflix, you win. If you can't, you get punished heavily, unless, of course, you take the block route and just cut your way to profitability.
It's a ruthless calculus. And that brings us to the end of this deep dive. But before we sign off, I want to leave you with a thought to mull over this weekend. We saw BlockFire, 4,000 people, 4,000 human beings with families, and the stock market rewarded that action with a 24% rally.
It is a really jarring statistic to look at.
It is. And it forces a very uncomfortable question. Are we entering an economic cycle where AI and corporate efficiency are valued so much higher than human capital growth that firing people becomes the primary way a CEO generates alpha?
That's the big fear.
And if that's the established trend for 2026, what does that mean for the broader consumer economy? Because if every major company cuts their staff to boost their margins, who is left with the disposable income to actually buy the software subscriptions and the hardware?
That is the ultimate macro paradox we are going to be watching all year long.
Heavy thought for a Friday, but that is the reality of the tape today. Thank you for listening. We'll see you all Monday morning with new headlines from major financial magazines.